macro market trends, stock selection, ETFs, options, just some of the topics covered in Cook's Kitchen.
Time for Mr. Market to go to the doctor again and get a checkup on his internals. Take a look under the hood, so to speak, and we're going to do that with several market breadth indicators. Now, the simplest way to find market breadth is just to look at indexes like the NASDAQ and the Russell. And when those indexes are leading, that's telling you we have strong market breadth, and it justifies whatever the S&P or the Dow or the NYSE are doing. So, we've got a broad array of stocks all moving higher, from different sectors and different growth appetites. But let's take a look at some other ways to measure the internal strength of Mr. Market. All right, first up, just taking a look at the percentage of S&P 500 stocks above the 50-day moving average. And this is a one-year view, and I've highlighted 55% on the downside, which can, in this bull market, has been sort of a buying area below that, and up top, 85%, where the market has generally turned when we've had a short-term turn. Now, let me qualify this by saying, so we're going to look at breadth indicators for the last year up to 3 years, and so the stuff you're seeing for the last year is very indicative of the bull market we've had, which doesn't mean it's going to continue like it has, but this is the way we're measuring the weather right now. All right, so back to this one, percentage of stocks above the 50-day moving average. I just want to point out, hey, we're right in the middle of my buy band and my sell band, so not really telling you much there. Next, let's go to new highs, new lows. This is the total U.S. market, so this is probably even more than the NYSE index. It could be over 5,000 stocks. Same deal. We're kind of in the middle between a buy area and a short-term sell area. And again, this is just the past year, so indicative of the bull market we've had. But the good news here is that highs minus lows, which is what this index is, and these are 5-day totals, by the way. This is looking at the last 5 days added together, trending up. So that's good. All right, next we're going to take a look at bullish percent indexes. We're going to look at the bullish percent index on the S&P 500. It is worth noting, though, that you can go to stockcharts.com and look at the bullish percent indexes by sector, and those have all been very strong too. As of last week, all 9 S&P sectors were in a buy zone on the bullish percent. Remember, bullish percent is using point and figure charts. So in this case, we're going to look at the S&P 500. Let's take a look. This is the percentage of stocks in the S&P 500 that are on bullish point and figure buy signals. So each stock, is rated for it's either a buy or a sell according to point and figure charts. And this is how you come up with the bullish percent index. I had to draw in the line here green because it looks like stock charts had some trouble with some of the past data going back beyond, say, 3 months. So I just filled that in with the big green line. I also left the 200-day moving average on here just so you can see the general trend. I generally don't use moving averages on oscillators or breadth indicators, but I just left it on here just to see the general drift. So, in this strong bull market for all of 2013, the bullish percent index, gravitated around 80. I'd be concerned if it came down and took out 75. That might indicate that the correction is coming, so to speak. And we don't know when that's going to be, of course. We've got a sentiment indicator that's telling us there's an extreme of bullishness right now, and that's the Investors Intelligence Survey, pushing 60% bullishness. That's an extreme where we've seen major pullbacks before. Right now, though, we've got an S&P that's hanging around 1840, looks like it's waiting to go higher. All right, let's take a look at some more longer-term breadth indicators. In this chart, I went out 2 years. Now we're going to take a look at the NYSE Summation Index. Remember, this is based on the McClellan Oscillator, which is a way of, they turned advanced decline statistics into an oscillator with the McClellan Oscillator. And so then what the McClellans did is they took their NYMO, which is called the New York McClellan Oscillator, and that's already smoothed out, but they smoothed it out even more to create the summation index, which is a longer-term gauge of buying and selling pressure. So I was worried about this last fall when the summation index comes and makes a new low, taking out the corrective lows from June. But it slowly worked its way back up and now is taking out the late October peak. And I've got the NYSE price index behind here. So that's what you're seeing. NYSE broke out above 10,000 in November, and it hasn't really come back down and tested that 10,000 level. It has been bouncing off of, say, this right-hand scale is actually for the summation index, but the point is that the NYSE is holding firm above 10,000, and we've got the summation index looking strong too. Okay, one more we want to take a look at, and this will take us out a little bit longer. This is sort of the big view I want to show you. This is cumulative advanced decline issues on the New York Stock Exchange, and this goes back into 2011. Now, so all we're doing is adding up, day after day, week after week, the advanced decline stats. So the number isn't really that meaningful. So don't worry about that 15,000 out there, or it's actually 156,000. The point is that this was the breakout here, taking out the May highs, May, June into the fall. We sort of had this, descending tops here. Could have been a triple top, and advanced decline broke strongly above that. So this is sort of a longer term indicator of the health of this bull market. And it's things like this that I look at, the shorter term stuff against the 50-day moving average all the way out to the cumulative advanced decline, while looking at the NASDAQ strength and the Russell strength. Put all this together, and it's why I can say something like I see the S&P going to 2,000 before it goes back to 1,500. And I might even be so bold as to say, we're going to get above 1,900 before we see 1,600 on the S&P. So, that's my bullish bent right now. That we could have some, definitely have some corrective action down to 1,780 on the S&P, but I think we're going to take out 1,900 before we go down and visit the 1,600s, and that's the way I'm playing it. With looking under the hood here at the breadth indicators. Also, the other thing I look at is individual stocks. We have to be stock pickers too, and none of this breadth stuff replaces that. In this market, that's where you're going to make your money, is being a stock picker. So the market timing stuff is fun, but when when you're looking at 10 to 30 stocks and investing in them, trading them, that sort of has your ear to the ground on what's happening in the indexes. When you can see strength in individual stocks, industries, and sectors, that's your real guide to market breadth. All right, thanks for joining me in the kitchen. Next week, I think we'll revisit the death of the secular bear market. I'm Kevin Cook. Thanks for watching.